Well, what is up, guys? It's Flash back with some more charts and another video. Today is Thursday, March 28th. It's about 6 o'clock p.m. Eastern Time. And I'm going to kind of do an extended or part two video from my previous one about there's a big move coming. What I'm referring to is gold and commodities and how we're kind of rhyming right now with the 1960s, late 1960s and 1970s. And so again, just going to continue that conversation. It looked like it was a popular video, and I just want to provide a little bit more context and go into a little bit more detail. And so what I have pulled up here is the S&P 500. If you watched that first video, I pulled this fractal. This is the fractal from the S&P 500 in the late 1960s into the 1970s, overlaid on today. It may not match up perfectly, but it's kind of a general talking point, a general fractal we can kind of talk through and compare. And this picture, you may have seen this before on X or on Twitter or on the internet, but this is CPI, year over year percentage. The blue is from 1966 to 1982, and the orange or yellow is from 2013 and currently 2023. And that is CPI, so Consumer Price Index. And so it kind of looks like we are rhyming with that with inflation, general inflation as measured by the CPI. Yes, you can make the argument that the CPI is measured differently, or metrics are changed, or what have you. I won't get into that, but generally it looks like the inflation from that time is matching the inflation from today. And you can kind of see there's three humps: 1, 2, 3. And so this chart is a little bit old, I think. I think we're probably closer to this bottom trough area. And if we are going to continue to rhyme, we'll be looking at some increased inflation over the next however many years, 5 or so years. And that, I think, is right to me. And I maybe not totally right, but I mean, we look at gold. Gold is tracking the destruction of our purchasing power. Gold measured in US dollars. That's my opinion, right? And maybe that is, we can look at some ratios and that can kind of prove that to you or help you kind of understand that. But look how strong gold is. That means it's sniffing out inflation, or it's pricing in the destruction of our purchasing power, right? Because kind of think about how Bitcoin is limited supply. There's a limited supply of gold. It can be used as money. It's been used as money for thousands and thousands of years. Like, gold, I think, is the real money in today's world. So that's point number one, right? Is inflation year over year. And if that's the case, I expect the S&P 500 to kind of match this fractal, go sideways for the foreseeable future, better part of a decade. Another ratio I want to talk through is the S&P 500 measured in PPI, Producer Price Index, a different way of looking at inflation. Rather than the Consumer Price Index, it's the costs of goods for producers, the producers that are making the goods for the consumers. And so I think that's generally a better way of looking at inflation. I think it's not as altered as CPI, right? And so this is interesting, right? Because if we go back through the years, let's go back to that 1960s, 1970s fractal. So this is the S&P. Well, I'll just kind of show it. Okay, so this is that fractal, right? Late 1960s, 1968, all the way through 1979 even. So this is the entirety of the 1970s. Up, down, higher high, lower low, arguably right here. Yep, higher high, lower low. It's kind of has this megaphone look to it, right? So in other words, it's just kind of going sideways. Now, if we look at the S&P 500, if we look at it and we compare it to the PPI, we measure it in PPI for the same time period. This means, look how the S&P has actually gone down versus inflation. So while nominally, measured in the US dollar, the S&P was kind of going sideways. that masked what was truly happening because inflation was running so hot that the S&P actually, you lost purchasing power because PPI was so high, producer price index was so high that it outpaced the S&P 500. So it took you a lot longer if you were invested in the S&P 500. It took you from, let's say you bought in the 1968 area, it took you until 1991 to start making gains in the S&P 500 when measured in inflation. I'm trying to explain that as best I can. While if we go back to this fractal, and we remove these drawings, if we go back to that same 1968 area, if you bought here and we go to 1991, you nominally made paper gains, like you thought you were making a lot of money if you were holding through this time period, but really, measured in inflation, your purchasing power was just breaking out if you held through here. So that's why I think it's interesting to kind of look at this and say, wow, if inflation is running hot, the S&P has gone down and sideways. So what's it doing, and see what it did in here in the, from 2000 through 2013, A, B, C correction measured in inflation. But if we go to 2000, let's take this off. If we go to 2000 nominally, it just went A, B, C, and you started breaking out in 2013. And then here, you really didn't start breaking out measured in inflation until 2016. So again, just a different way of looking at it. But what I'm saying is, let's go on the quarterly time frame. Got to silence the phone as usual. What I'm saying is okay, if the S&P breaks out versus PPI in 1950, great time to buy the S&P. It breaks out in 1983 against PPI, great time to buy the S&P, right? If you had this ratio handy, you would have made an incredible amount of money, right? Breaks out against PPI in 2013. I mean, what a massive run. So again, quarterly time frame. But what we can also take a look at is the breakdowns. Breakdown. Breakdown. So if you were buying in 1969, you had to sit through a ton of time before you started actually making legit gains in the S&P 500 as measured in inflation. If you bought, in early 2000s, 2002, you are losing money adjusted for inflation, right? So not really ideal times to buy. If you had this ratio handy, you maybe could have made better decisions, right? So now we go to current day. Current day, looks like we are breaking down and retesting, or we're kind of making a little bit of a higher high. We look at, this might help us out here. We're kind of making this rounded top of the S&P 500 measured in inflation in the 60s and early 70s. So let's copy, paste that over here. And you know what? Am I getting ahead of myself? Maybe. But this is kind of a rounded top. It's kind of rounded out, rounded out right here. We're going to have to see if this is going to be rounding out or not. Or is it going to break out of this channel? This, millennial channel, epic channel that we're looking at, right? S&P measured in PPI. If this breaks out of the channel, retest and continue going, then my thesis is totally wrong, and I'm happy to be wrong, and we will go long S&P, we'll go long tech, keep riding this massive wave, right? AI. And maybe that's the case. I'm not to say no one knows really what's going to happen, and so I'm just saying we're at the top of this channel. Looks like we're kind of rounding out. We broke down from this trend line. I would say this is the place. This is more likely a top than it is a continuation out of a millennial channel. Because inflation is running hot, right? And gold is kind of telling us that by this massive breakout of a cup and handle. And so I think it's tough to say, but we need more data. We need to see if this is going to roll over, if this is a rising retest wedge. If so, this tells us that, oh, one more little trick for you guys. One more thing to bring it all home. So we're going to stay on this chart, and I'm going to add XAU USD new price scale. And let's put this in a log. Okay. So this is where I bring it all home for the boys. And again, I'm a student of Patrick Karim and Kevin Wadsworth. Like, this is really their work that I am spreading their good message, right? So I'm gonna put this on the log chart. When the S&P breaks down versus PPI, gold goes to the freaking moon. Absolute moon. I mean, this is an incredible move by gold. And then when the S&P breaks out versus PPI, gold is generally topping. It made its run. So we want to rotate out of US equities at this section, get into commodities, ride the commodity wave up, and then when we see S&P breaking out versus commodities, versus inflation, we want to rotate out of gold and commodities and rotate back into equities. Ride the equity train, the gravy train up, and then we see it breaking down versus PPI. Gold is going on a massive run. Gold and commodities are going up, up, up. We want to ride that wave. And then when S&P breaks out versus PPI, that means we want to rotate back into equities. And so, again, present day, gold, massive breakout of this cup and handle. S&P is breaking down versus PPI. It looks like so far, maybe a little bit of a retest here, but look at gold's already going to the moon. It's already going. And I don't even think it's, there's not much of a question here to say you want to be in hard assets, equities in gold, silver, oil, uranium. And so then that just brings me back to URA. Because I think URA looks the best out of all of them so far. And you can make an argument, for gold and silver, they could be bottoming out. We could be nearing a liftoff period, but it all comes back to uranium. So we're making support here at 27, 28 bucks, and I think we're going to continue our march upwards. So guys, I hope that's helpful. Different perspective for you. Let me know what you think in the comments. Drop a subscribe and a like if you find this useful. And guess what? I will see you in the next video. Take care, guys.